Good afternoon, everybody. We're going to give it maybe another 30 seconds here to let people arrive and join, and then we'll get started. All right. Good afternoon, and welcome to today's presentation on navigating long-term care insurance. I'm Russ Austin, Associate Vice Chancellor for Plan Giving. I'm thrilled that so many folks are joining us today from across the country for the second program in our series of informational webinars designed to provide timely information and insights in a variety of financial, tax, and estate planning topics. Future topics will include an economic outlook and panel discussion of the proposed Biden tax reforms this fall. Before we begin, I'd like to let you know that we are recording the program and it will be available along with previously recorded webinars on the Plan Giving website. If you'd like to submit a question for the Q&A portion of the webinar, please submit it through the Q&A function by clicking the Q&A button in the middle bottom of your screen. As a reminder, we would appreciate if everyone will mute your microphone for the duration of the program. Last, should you have any technical difficulties, please send a chat message to Kim. The chat button is next to the Q&A button, and then you click on the drop-down to select WashU Tech Support -Kim. It is now my pleasure to introduce our keynote speaker, Tyler Horning. Tyler is a principal partner at TDC Life, an independent life insurance and estate planning firm headquartered in Ohio. TDC Life works nationally supporting professional advisors and their clients, including high net worth individuals and families, closely held family businesses, and professionals. The Office of Plan Giving at Washington University has partnered with TDC Life to add value and expertise to our life insurance program. Tyler has more than 15 years of experience in the life insurance industry and is life licensed throughout the United States. He joins us today to share the insights into the options and benefits of long-term care insurance. Please join me in welcoming Tyler Horning.
Thanks so much, Russ. Excited to be with y'all. I'm going to be sharing my screen here, and we'll get rolling. So, great. So today we're going to be talking about long-term care insurance, and I think just the participation that we've seen on this webinar goes to show that there are a lot of people that are concerned about this topic, that are thinking about this topic, and want to learn more. And I think that's due to the fact that many of us have had an experience with a loved one, or know someone that's had an experience with a loved one that's had to deal with a long-term care issue, and we've put ourselves in those shoes and say, well, what if that was us? What would we want? So I think it's smart to be thinking about these things. I think it's smart to be planning, and we're going to talk about kind of the ins and outs of this topic. So as we get rolling, I'm just going to give you some quick background on who I am and why the heck I'm here talking to you about long-term care. We're going to talk about some basics on long-term care, talk about kind of the problems and solutions that we've got in this space, and then just thinking through some frequently asked questions and some case studies. We'll try to have you all out of here in just under an hour with plenty of time for questions. So again, my name is Tyler Horning. The name of my firm is TDC Life. We're based in Toledo, Ohio. We help people do three things. We help them acquire insurance policies. That's life insurance, long-term care, some of the things we're going to be talking about today. We help them strategically manage those policies. And then if needed, we help them get out of those life insurance policies through something called a life settlement, which we'll touch on quickly. So I want to first start with just some examples. These are three clients of mine that have gone through the long-term care journey, and I just want you to think through this or just hear their story, because at the end of the day, everybody is in a different situation, and you've got to think through what's right for you and what you're comfortable with. Because there are no right or wrong answers in the long-term care conversation, and candidly, it's only at the end of your life or at the end of needing care where you're going to know exactly what was the right solution. So you have to pick one with limited information that you feel comfortable with and that you're willing to kind of move forward with. So just Mr. and Mrs. D, longtime clients of mine and my firm, husband and wife. Mr. D died at age 72 of cancer. He was in the hospital for all of 6 weeks, died of cancer, never needed long-term care. And Mrs. D lived, she's 92 right now, and she's just now needing long-term care and gone into a long-term care facility. They did buy a long-term care insurance policy. And again, at age 92, Mrs. D is now just starting to use that product to pay for her care. Mr. and Mrs. L, Mr. L literally just passed away earlier this week at age 94. And he and Mrs. L were longtime clients of mine. They went through their whole lives. They stayed at home. Their family took care of them. They never actually needed long-term care, and they didn't buy a long-term care policy. They were hopeful that their family would be able to take care of them, and that's ultimately how it played out. And Mr. L was healthy kind of one day, and over a week's period of time, quickly declined and ended up passing away. But they didn't buy care and ultimately didn't need care, and that's what they felt comfortable with as they went through this. Mr. and Mrs. I, these happen to actually be my grandparents. They're both living. They never ended up buying long-term care. What they decided to do is, at age 80, they decided to move into a transitional long-term care facility where they live in a house right now. If they ever need care, they'll move into kind of an apartment, and then they'll move into the actual long-term care facility. And that was the solution that was kind of right for them. They both have illnesses that likely will take their lives at some point in the future. But right now they're doing great and not needing any help through their life. I share these stories with you because we all have stories like this, and these stories and our experience of people that have been close to us kind of shade our thinking about long-term care. But really, at the end of the day, whether you insure for long-term care or you don't, it's a business decision. You have to take all of the information that you have at your fingertips, what you emotionally feel good with, what you're able to handle financially, and you have to make a business decision, and you have to be comfortable with it. Because again, if we took each of those 3 clients of mine and we rewinded the tape 20 years before, right, to when they were in their 70s or when they were in their 60s, it would have been so hard to know exactly how this was going to play out for them. So they each made a decision that they felt like was right for them. And then you just have to live your life and be comfortable with the decision that you made and kind of deal with it as time goes by. So what we're going to find out is there are lots of options. They can be great options. They can be a bit overwhelming as you think through this. But it's about picking an option and kind of dealing with what comes as it does down the road. So let's start with what is long-term care insurance. So all of us have a risk, and that risk is needing extended care in a medical facility. Long-term care is needing long-term care in one of those facilities, but not having that care being covered by health insurance, right? Most health insurance policies have a limitation on what they'll cover, and it's kind of where health insurance ends that long-term care insurance picks up and helps to cover the cost of needing this care. So that at the end of the day it's needing a higher level of medical care that's not covered by health insurance. every long-term care policy that's out there has two triggers. There's two ways where you could start qualifying for the benefits of a long-term care policy. And those triggers are severe cognitive impairment. This will be something like Alzheimer's disease or severe dementia, where you lose your mental facilities, or you're unable to do 6 activities of daily living, and they're listed here. I won't go through each one of these, but you're unable to do 2 of those 6 activities of daily living. That's where you're considered needing long-term care, and that's where these types of policies that we're going to talk about a lot more on this call will kick in. So these are ultimately the triggers where this type of policy works. So you don't have to buy insurance to protect the risk of needing long-term care. Many folks will self-insure this risk. They will just say, hey, we're going to hold our assets. We're going to manage our assets in a way that if we ever need care, we can pay for it out of pocket. Others will decide that insurance is the right answer, and they will try to offload this risk of needing extended medical care to an insurance company. And there's a few different insurance type policies you can use to cover this risk. Again, we'll talk about this a lot more through this presentation. So in the 3 examples that I gave, some of those clients decided to self-insure that risk. And for Mr. and Mrs. L, that made a lot of sense. They actually made the right decision at the end of the day, because had they bought a long-term care insurance policy, they would have never collected any benefit because they stayed at home and never actually had long-term care. They probably could have qualified for it had they had a policy because of those triggers, but because they never entered a care facility, they never had professional care. Their families were the only people that were taking care of them. They would have never actually received any benefit from a traditional long-term care policy. For Mr. and Mrs. D, one of them, Mrs. D, is actually using her long-term care policy. She's in a facility. The insurance is kicking in. But again, they kind of wasted premium on Mr. D's life because he died prematurely and didn't need the care. So again, these are the 2 decisions, and it can evolve over time. But self-insurance or buying insurance really is what we're talking about here. So if you decide to self-insure and you need care, you use your assets to pay for that care. There kind of is a stopgap. There is ultimately a catastrophic policy that's out there, and those are Medicaid benefits. If you do ultimately spend down your assets, Medicaid will kick in, which is a government program that will help to pay for care for you. Unfortunately, with the Medicaid program, you do have to spend down your assets to qualify for Medicaid, which means that your beneficiaries and your family that you may ultimately want to get some of your wealth will not be able to get it. You will have to have spent down your wealth to pay for care before you kick into Medicaid. There are ways to kind of work around that and transfer some wealth through the generations and still rely on Medicaid, but those rules are complex, and you really have to start planning far in advance of needing the care. And most folks' crystal ball is not good enough to know ultimately when they might need long-term care to be able to plan well in advance. Like my grandparents have done, you can buy into a transitional community where you start at one end of the spectrum and work through the care levels. And those facilities often will agree to take care of you indefinitely if you run out of assets. But again, that means you're spending down your assets over your lifetime, consuming those assets, and there won't be anything left over to pass down through the generations. So one of the major reasons that folks like buying long-term care, like insuring this risk, is the ability to make sure that there are assets that pass down as an inheritance over time. So I know we've got some questions that have come in. I will try to monitor these questions and work them into the presentation. If I don't get to them while I'm going through the presentation, we'll make sure to circle back at the end. I know one of the big questions that actually came in advance of this presentation, and two that have come through here is long-term care insurance only available if you need care in a facility? And the answer is potentially. So some long-term care policies that you buy only qualify or only pay out when you need care in a facility. Others have an at-home healthcare option. Well, they'll pay for care if you decide to stay at home. That's a feature or a rider that you can have on the policy. But most traditional long-term care policies will only pay out if you're actively paying some professional person to care for you. That would be called a reimbursement type policy, where they'll only pay for an at-home nurse through a professional organization, or they'll only pay a facility, official long-term care facility. There are other policies, which we'll talk about a little bit, that are called indemnity policies. These types of policies pay out if you meet the triggers, no matter if you're getting professional care or not. If you want care from your family, and you meet the trigger requirements of the policy, these indemnity type policies will still pay out a benefit. So we'll talk about that a lot more as we go through the presentation. So I'm just going to talk a little bit about the history of long-term care insurance. This is a type of insurance that's been around for some time. The 1960s is really when nursing homes started. And they had nursing homes. People would go into nursing homes, but people were struggling to afford these new types of care facilities. So in the 1970s, this long-term care type insurance policy started. And in the 80s, it kind of grew. And really in the 90s is when long-term care came into its own. There were a lot of long-term care policies that were being sold. They were relatively inexpensive, and they had relatively comprehensive and generous benefits. But what happened in the early 2000s is people bought policies in the 1990s, and they started to live longer and longer and longer in the early 2000s, because these great long-term care facilities were extending people's life expectancies. So insurance companies had to pay out benefits in much greater amounts and for much longer periods of time than they had expected. And so really in the early 2000s, insurance companies started getting in trouble with the promises that they had made back in the 90s and the 80s. And so in the 2010s is when we started to experience kind of the awful thing that's happened in long-term care facility over the past number of years, is we've actually seen increases in premium on long-term care policies that were sold in the 90s and 2000s. And really that comes down to life insurance companies were paying out more in benefits than they ever expected to pay. And the policies had more generous benefits than they expected they were going to have to pay out. And so what these companies had the ability to do and have ultimately done to policyholders is they've increased the premiums, which we're going to talk about what to do if that happens to you over time. And so a lot of people have kind of had a bad taste in their mouth with long-term care policies because of that. And the long-term care industry, the insurance industry, has come up with some new products that kind of solve some of those problems and maybe have become more attractive for policy holders over time. So we're going to talk about some key terms. So there's some terms that I've been using and that we're going to use throughout this presentation. We're going to follow up with a document which will have these definitions, so no need to take notes. But as you talk about buying insurance for this long-term care need, there are certain phrases that will come up from time to time. The first is something called an elimination period. All long-term care insurance policies have an elimination period. And the elimination period is how long you must wait after needing care or after hitting those triggers before a benefit will start paying out. That elimination period could be 0 days. Some policies have a 0-day elimination period. And other policies, it may be 90 days or 180 days. If you have a 180-day policy, you've got to cover that cost for the first 180 days before you'll start receiving care on the policy. For the policies that have 0-day elimination period, obviously they can't start paying you a check right away, but you'll receive benefits back to the first day where you met those triggers, and they'll kind of catch up with that first payment after you've made a claim and gone through the whole process to cover that. A 0-day elimination period is great, but it's maybe overkill for some people. A lot of people would have the financial wherewithal to make it 80 days or make it 180 days and pay for that care. And you get a discount on your premium if you have a longer elimination period. The next is the benefit amount. How much are you going to get in this policy? And there's that benefit amount will typically be broken down on a daily or monthly benefit period. And they'll calculate based on, you get $150 a day per day for a period of time in benefit, or you get, $5,000 a month in benefit from the policy. You couple that with the benefit period, right? Maybe it's a 5-year benefit. So you get $5,000 a month for 5 years. You do that math, and that calculates the benefit pool. How much in total will this insurance company pay out over the life of the benefits? Back in the day, historically, you could buy an unlimited benefit period, which would mean that the benefit pool was unlimited as well. Those types of policies are not available anymore. And if they were, they'd be extremely expensive, because that's how these insurance companies kind of got burned in the past, where they signed up and were on the hook for this long benefit period. Some policies have an increase feature, right? So if you buy a $5,000 a month benefit today, you may get a 5% increase feature. So that means as long as you have the policy, that $5,000 a month will go up every year by 5%. Until you ultimately need care. There's simple interest, there's compound interest, there's lots of different ways that you can feature that, but an increase feature is a good way to maybe buy a smaller benefit now, knowing that hopefully you're not going to need it for 10 or 20 years, but have this policy kind of keep up with inflation so that the benefit will fully cover you when you ultimately need care. Home health care, we talked about a little bit here, is will the policy pay out if you're needing care in your home? And many of the policies will. And again, we've touched on this idea of indemnity versus reimbursement. A reimbursement type policy will only cover care from a professional caretaker, and you have to pay for the care, and then you get reimbursed for those expenses that you've outlaid. An indemnity type policy says, if you meet those triggers, the 6 activities of daily living or the cognitive impairment, if you meet those requirements, the policy will start paying out a benefit, whether you use that benefit to pay for an actual care facility, or you use that benefit to pay your family member to come in and take care of you, or you use that benefit to go take a trip around the world or go visit your family or whatever it might be. That type of policy gives you more flexibility on how the benefits are used. One of the questions that came through, and kind of along this topic, are policies that limit nursing home to assisted living facilities more expensive or less expensive than policies that would maybe cover more broadly. And typically, the more limited the benefit payouts are, the more expensive a policy might be. So we can play with the riders and features of the policy to kind of zero in on a premium. And I would tell you again, historical policies that have been purchased in the past typically have better benefits for a lower cost than any of the policies that are available today. Insurance companies truly have learned their lessons with these policies, and they've put limitations in the policies to protect themselves from these situations where they're paying out more than they expected to. And so that well, as a rule, we typically have people keep their existing policies before we'd replace them with a new type of policy, because you just can't buy those policies anymore. Okay, so there are really two major types of long-term care insurance. The first type is traditional long-term care insurance. This is the stuff that's been around since the 70s and 80s. This is the stuff that the insurance companies lost their shirt on in the past. This is the stuff that's still available, but on a more limited basis. Traditional long-term care insurance, I liken to fire insurance or automobile insurance. You buy it with a relatively low premium. It protects you if you have a fire or if you have an automobile crash. But if you don't have one of those things, i.e., you live your whole life and never need long-term care, you've paid premium on a policy and never got any benefit from it. So you have to think about this more as other types of insurance policies where you pay a premium. It's kind of the cost of doing business. You wouldn't think of owning a house without having homeowners insurance on it. It's just the same thing with traditional long-term care insurance. But for a lot of folks, they don't like that idea. They say, hey, well, I paid premiums all these years. I don't want to go through a scenario where I don't get any benefit from this policy. But if you think about it like automobile insurance, it makes a little more sense, and it really puts it into a context that maybe it likens it to automobile insurance, where it maybe makes some sense. So the benefits of traditional long-term care insurance is there's a lot of customization. We can dial in these riders. We can dial in the benefit amounts. We can set up an increasing benefit period. We can really make this customized, which can customize the premium and maybe fit it into a budget. The benefits pay out tax-free. The premiums can be tax deductible. In fact, you can even use HSA dollars that you may have built up over your working years. You can use that health savings account money to pay for these long-term care premiums. And really, these premiums are going to be lower than other options that we're going to talk about today. But the cons are that the premiums are not guaranteed. They can increase them on the future, and you may or may not use those benefits. Again, we go back to Mr. and Mrs. D. Mr. D didn't use the benefits at all because he died prematurely. Mrs. D ultimately, just now at age 92, is starting to collect on the policy. The question is, will she live long enough in the care facility to actually use more than what she's paid in premium into this policy? So had Mr. and Mrs. L, right, who lived their whole life, never needed long-term care and died at home being taken care of with their family, had they bought a policy like this, they would have paid out they would have paid premium and never received any benefit. So kind of in response to some of these concerns and some of the drawbacks of these types of policies, insurance companies have developed new products, and we call these hybrid life insurance long-term care policies, because they often are built on a life insurance chassis, but have benefits that will pay out if you need long-term care. They will pay out a death benefit if you don't need long-term care. So the insurance companies have kind of recognized some of the shortcomings and risks with traditional long-term care policies, and they've tried to build these hybrid policies that answer some of these questions. And what we've experienced over the past 10 years is a dramatic decline in the sale of traditional long-term care policies, as we've seen a big rise in the sale of these new hybrid type policies. And it's a little bit of both. The insurance companies feel more comfortable with the hybrid policies, but also that consumers are demanding these hybrid policies that maybe answer some of the concerns with traditional long-term care. So we've talked about this a little bit, but so a hybrid long-term care life insurance policy has a death benefit. That death benefit can be used during your life to pay for care, or that death benefit can be used at your death as a traditional death benefit. So you have one pool of money And if you use it for care, it pays out there. If you never need care, it'll pay it at death. If you use part of it for long-term care, the rest will pay out at death. So we're eliminating this use it or lose it type risk. The premiums can be locked in and guaranteed in some cases. And these types of policies can be set up as indemnity policies where, as long as you meet the triggers, the benefit will pay out whether or not you're in a long-term care facility. Really, the drawback here is these types of policies cost a lot more than a traditional long-term care policy, because the insurance company knows now they're gonna pay out some sort of benefit, whether it's at death or during life for long-term care. They know they're gonna pay out some sort of benefit. And if you use the long-term care, it reduces the death benefit. And so, folks that say, I want to make sure there's X dollars that are available for my family, in this scenario, they would reduce that amount using these hybrid type policies. I'm just going to quickly look through these questions here and see if there's any I should address. Yep. Okay. We'll address those here in a minute. So just by way of kind of a direct comparison, I'm going to kind of work through, this is a client who was 68 years old. We looked at both traditional long-term care and one of these hybrid policies. So just from a dollars and cents standpoint, this is the way that this kind of shook out. So we're going to first work through traditional long-term care, and I'm going to kind of pull together all the things that we've been talking about thus far in the presentation. So the premium. So this client is a gentleman, 68 years old and relatively good health. The premium for a long-term care policy, which was a pretty good policy for them, was $4,773 a year. That would buy a $5,000 monthly benefit amount for this person. That monthly benefit amount would pay out in total a $300,000 pool of money. So this is a 5-year policy. So it pays out for 60 months. And that's where we get the $300,000 pool of money. But we put a 3% compounding increase on this benefit amount. So every year this benefit is going to go up by 3% to a total for a total of 20 years. After that compounding 3% amount over 20 years, that benefit would actually grow to a $500,000 benefit pool. And what you're going to see, that's why we're comparing it to a $500,000 benefit pool under this hybrid policy. So we were able to start low and have an increase over his lifetime. Has a 90-day elimination period. So he's got to cover the cost for the first 90 days of care out of pocket. At the end of 90 days, he'll start getting the payment under this plan. And this is a reimbursement type plan, right? So he's got to pay for care, and then he gets reimbursed by the insurance company for the cost that he paid. So this type of policy would cover home health care, would cover adult daycare, cover assisted living, nursing home, respite care, hospice care. This type of policy would cover any of those levels of care, but it has no death benefit. Remember, this is traditional long-term care insurance. So if you don't use it, you'll lose it. And there's no cash value. There's nothing that builds up in this policy over time. So if 10 years from now, he decides he doesn't need care, and he wants to give up the policy or can't afford the policy or whatever it might be, nothing left for him at the end of the day. So that's traditional long-term care. Directly comparing that to a hybrid policy. So this hybrid policy costs $18,000 a year, significantly more than the traditional long-term care, but I'd argue a different set of benefits that potentially are significantly more than what you might get through traditional long-term care. So now from day one, there's a $10,000 a month monthly benefit. So if he needs care day one, he's going to get $10,000 a month of benefit that'll start paying out from day one. If on day one he dies, there's a $500,000 death benefit that's going to pay out on this policy that would go to his family. But again, from day one, there's a $500,000 pool of money as well for long-term care. So if he needs long-term care on the first day, you'd much rather have this policy than you would traditional long-term care. The reason we made this business decision to start with a lower amount here is to save on premium, right? So this was a premium comparison here on this policy. So no increasing option because we bought the final benefit amount that he would have on traditional long-term care from day one in this plan. No elimination period with this policy. So again, from day one, if he meets those 6 triggers, he's going to start getting this benefit. And it's an indemnity benefit. So if he meets the 6 triggers, he's going to start getting a $10,000 a month check right off the bat that he can use for any purpose, whether it's medical or non-medical. Same triggers in the policy. And again, this policy has a $500,000 death benefit, and it has a cash value that will build up over time. So in 10 years or 20 years or whatever, whenever in the future, if he decides to go in another direction, there's residual cash that he can pull out of the policy if he decided to change course. So just a direct comparison. Again, every comparison is going to be different. This is a 68-year-old gentleman, so a little bit older on the age scale, but hopefully a way you can directly compare apples to apples with these 2 different types of policies. There are lots of flavors of ice cream, right? So on these hybrid policies, there's some that are more focused on death benefit. There are some that are more focused on care. There are some that are more focused on cash value. There's some that are focused less on cash value. So lots of different ways to build this. Yes. So great question here, and maybe a good place to address it for reimbursement. For reimbursement programs, if you use less than the monthly amount, does the period of time extend to the pool amount? Absolutely. So, so if you used, in this case, we've got a $5,000 benefit, but if care only costs $2,500, that just means you could use it for a longer period of time. Very, very good question. And it's the ultimate benefit pool that governs this. Yeah, so another question here, a great time to answer it might be, can you discuss single one-time premium hybrid policies? So these types of policies have a single premium. I call these more asset-based long-term care policies. So instead of there being an $18,000 a year premium in this scenario, maybe it's a one-time $150,000 single deposit that goes into the policy. That policy becomes paid up, no expected additional premiums, but you've given the insurance company kind of all the money up front. Those types of policies will have a lot more cash value than what we've got here, because you've given more money to the insurance company up front. And often those policies have what's called a return of premium rider, where if 10 years from now, you wanted to cash that policy in and go in a different direction, they may give you all of your premium back in the form of a check if you looked at it that way. So those are definite policies that are out there, and we've seen a lot of those policies in use. It costs a lot more up front, but you have this additional benefit of having that cash value where you can get your money back. A lot of the sales of those policies come from folks that maybe have a lot of money sitting in cash and they're uncomfortable with putting it into the stock market or investing it in a different way, or they have money in a CD. So they might take some of that money that they've got where they want it to be liquid, they want it to be protected, and they take a portion of that money, put it into the long-term care policy. They know they can get it back at any point in the future because of that return of premium feature. But God forbid if they need care, the policy would leverage up that money in that single premium. So that's a good policy that's used there. Another question is, can an index universal life policy be paid for a lump sum up front, or do you have to pay it over time? And you can design it either way. Those policies are flexible in that way. Okay, moving on. So one of the major questions that we got in the pre-questions, one of the ones that we've got clients that are dealing with, and one that I'm sure is burning in folks' mind, is, so you've talked about these traditional long-term care policies potentially having future increases in premium. And so I said this is one of the great black eyes on the insurance industry is long-term care insurance, where these insurance companies misjudged what it would cost to pay for this care. And part of that was due to competition. Part of that was they really didn't understand the risk. Part of that was, medical science has gotten better and is keeping people alive down the road. But the way that works is you will have a long-term care policy. The insurance company will send you a letter and say, after careful consideration, we've decided that we need to increase the premium on your policy. And they can't do it for your specific policy. They can't say, Russ Austin, we're worried about you. We think you're going to need a lot of care. We're going to jack your premium up. They can't do that. They have to say that everybody fits in kind of Russ's demographic. All the policies that were sold between 1995 and 1996 that had these features, we're going to increase the premium. So they have to do it on a class basis. But what they're going to do is they're going to offer you some options. They don't just say, raise the premium. That's the only thing you can do. They're going to give you options. And literally, this is a letter that one of our clients received. This happens to be from a company called Genworth. Genworth was one of the largest sellers of long-term care insurance out there. And so it's just a common letter that you might see. And so they give you options. So the first option is keep the current policy. So with this current policy, it's got a monthly maximum benefit of $9,000 a month. That's a lot of benefit. The benefit period is 5 years, and it has a compound 5% inflation protection. So this benefit amount is going up 5% compounding every year. It has a 90-day elimination period if you're in a facility. It has a 0-day home health care elimination period, and they're paying a premium of $7,000 a year. And so to keep that policy as is, they're going to experience an increase in premium of 42%, a 42% increase in their premium amount due to this increase that's kind of coming down the pipe here. So they can pay that increase and keep the benefits that they've got, or they can select some options and select a different premium. And so if they decide to keep the benefits where they're at, the premium's going up to $7,000 a year. Alternatively, they can, in this case, reduce the compound amount. So instead of it being 5% compounding, it's 1% compounding, and they'll keep the premium the same. Or they could they could add co-insurance where they may have to start paying some of the care, and that will keep the premium the same. Or they can, in this case, adjust the coverage in a different way. So the point is there are lots of features here that would allow them to adjust the premium to keep the premium lower, but it includes an adjustment in benefit. Oftentimes that adjustment in benefit makes some sense. Adjusting that compound, they already have a great benefit now. Maybe adjusting the increase down the road maybe makes some sense to keep the premium down. But again, this becomes a business decision on what you do. But the good news is you have options. A lot of what we do is maybe consulting with folks to think through their options. So we'd be happy to talk to you about a situation if you had this care, or the agent that sold you the policy, they may be able to help you think through this, or your financial advisor that you might make sense might help you to think through this. But there are options, and that can't be understated. Okay, just moving on to some other frequently asked questions. Hopefully this will answer some of the questions burning in your mind. What's the typical age that folks purchase long-term care insurance? We get this question all the time. And the tongue-in-cheek answer is the day before you get sick. So if you could tell me the day where you're going to get sick and wouldn't qualify for the coverage, that's the day you should buy long-term care insurance. Unfortunately, nobody knows that date. And so the day when you're healthy, you can afford it. And typically it's when people move towards retirement, because during your working years, disability insurance is really the important insurance to have. And that will cover you. God forbid you need long-term care, your disability insurance policy will kick in and start paying benefits that you could use to pay for care during your working years. But again, more directly, it's kind of the 50, 60, 70 age range are when people are considering this. I'd say, 60s is a age range where people are typically in pretty good health. They haven't experienced a change in health where they might need care. And that's a good time to lock it in. We talked about health savings accounts a little bit. Those health savings accounts can actually be used to pay for care if you need it down the road. They can also be used to pay for long-term care insurance. And there's different limits depending on your age as to how you can use that. How do you qualify for long-term care? There's an exam process that you have to go through. There's a medical history process that you have to go through. There's an application process. Buying traditional long-term care insurance is a much more difficult qualification period. It's a much more difficult underwriting period up front if to qualify for it. The hybrid long-term care policies are much more liberal in the way that they will take folks in. So that's one to consider if maybe you've been turned down for traditional long-term care. Maybe think about a hybrid policy to cover you as well. Here's the $1 million question, which is what's the right amount of insurance? And that is a very difficult one. And there really is no right answer for folks. There are some resources to look at. Genworth has a great calculator on their website, which we're going to share the link after this presentation, where you can go on there and you can say where you live, what standard of care you'd like to be cared for at, and they can give you a sense of what that costs in today's dollars. But really, I think this decision needs to be coupled with your financial advisor. And clients that we work with, we do what's called a Monte Carlo projection. So we take their asset level, we project out cost of care, we project out how much they want to leave to their family, and we can build in the cost of a long-term care policy, and we see how that will impact their financial security going forward. And so it really is a very individualized decision. But it usually starts with what does care cost in your area, and the traditional need for long-term care is kind of in that 3 to 5 range. 3 to 5 years of needing long-term care is what we typically see. So you multiply 3 to 5 years of needing care by the cost of care in your area, and that gets you on track for kind of a care amount. Again, we'll circle back on some more questions that have been submitted here right along. So like I talked about, this Monte Carlo simulation, this is a financial security projection, right? It tests your situation. It says, well, what if the market goes up? What if the market goes down? What if interest rates go up? What if interest rates go down? And runs a lot of different scenarios to see what's your probability of having enough money at the end of the day. And that Monte Carlo can be a great tool for folks to make sure that they've got financial security and give them confidence in the decisions that they're making, the business decisions that they're making for their financial life. Do we insure or not insure? This Monte Carlo can be a great tool. And again, financial advisors are ones that typically do this for folks. So if you work with a financial advisor, I'd recommend asking them to do a financial stability projection or a Monte Carlo projection. If you don't have anybody that can do that for you, that's something that we do for folks. But this was a client that wanted to give $6 million to his 3 daughters, so $2 million each. So we said, hey, we can take your money, we can manage it to get to $6 million at the end of the day. So you have a $6 million pool of money for your daughters. And based on your assets, this is what it's going to look like. You have a 75% probability of having $6 million in assets at age 95, just with your with what you've got going on right now. you also have a 30% probability of having $28 million in assets. So a wild swing there, but a lot less confidence in having the 28 million than 75%. We said as an alternative, we could buy a life insurance policy. We could put on this long-term care feature, so that would help protect the money for your daughters. You wouldn't have to spend your money down if you need the long-term care. And if we do this, you now will have a 98% of having at least $6 million for the benefit of your daughters. And you'll have a 50% probability of having that $28 million for your daughter again. But by building in one of these hybrid long-term care policies, we were able to increase his financial projections of meeting his goals of $6 million for his daughters at the end of the day. And we were also able to protect him on a downside if there was kind of an unexpected need for long-term care. So again, integrating financial planning and long-term care insurance is a really smart way to go about doing this. The next is kind of transitioning from somebody that really needed life insurance during their working years and had bought life insurance in the past to taking the just straight life insurance policy and turning it into a life insurance long-term care policy was a really smart way to do that. So we took a life insurance policy that was just a single purpose vehicle that had cash value build up in it. We exchanged that policy from just straight life insurance to one that could cover long-term care and life insurance. And we were able to buy more benefit that was more flexible because they could use it for long-term care by doing that exchange. So that would be repurposing an old life insurance policy that maybe was great at one time, but now redeploying those dollars in a new way that could help cover long-term care insurance as well. Another is there's actually a market for long-term or for life insurance policies that aren't needed. So life insurance policies that aren't needed can actually be sold for cash on what's called the secondary market. This is something called a life settlement. And we talked about this in our last presentation that we did to this group. So forgive me for repeating myself if you were on that presentation. If you weren't on that presentation, I recommend you go back and listen to it. It's on the WashU website, and that's where we talk about life insurance and redeploying life insurance policies. But in this case, the client was able to sell their traditional life insurance policy for more cash than they had in cash value. We were able to take that money, redeploy it into a life insurance long-term care policy and better protect their family and leave more money in their estate. And then finally, there's a way to build in charitable giving with a long-term care policy and with a life insurance policy. And in this case, the client wanted to give money to a charitable organization. They also wanted to protect their family. They wanted to make sure that their family was protected. They also didn't want to be in a situation where they didn't have the cash to pay for long-term care. So what we designed was a $5 million life insurance long-term care policy. That $5 million life insurance long-term care policy had a $2 million rider that would pay for $2 million of long-term care if they needed it. That was the benefit that they gave to their family. And then they gave taxable assets that were in their estate to charity at their death. So by combining these kind of three beneficiaries, the long-term care policy, the life insurance policy for their family, and charity, they were able to kind of draw down their estate, pay less in estate taxes, give more money away to charity, and protect themselves if they ever needed long-term care. So again, by thinking kind of cross purposes, where we bring in charitable planning, financial planning, long-term care planning, life insurance planning, we're able to take kind of 1 + 1 = 3 or 5 or whatever it is, but more by doing that planning. So just some key takeaways. Long-term care is care that's not covered by health insurance. You can cover with long-term care insurance. To insure or not insure is the question. If you don't buy insurance, you're automatically self-insuring. There's kind of a backstop, which is Medicaid or maybe long-term care facilities and kind of moving into one of those facilities. But Typically, long-term care is needed on a sudden basis. You're not going to know the day before you're going to get sick. And so you got to start planning for that well in advance of needing the care. All long-term care policies, even with increases, typically are better than policies that you can buy on the market today. You just may want to think alternatively about those policies and find different ways to reduce the premium. And these new hybrid long-term care life insurance policies may provide additional planning flexibility in your plan. So I'm going to stop. I know we've got a few questions coming in. Russ or Brigitte, I know you had some prepared questions that we might want to ask. I'm sorry, I've talked a little long here.
Yeah, no worries, Tyler. Thanks so much. This has been great. We appreciate the information. We have received a number of questions ahead of time. So with the short amount of time here, I'm going to turn it over to Brigitte to ask those questions.
Thanks, Russ. Tyler, we had a couple of questions about what loopholes exist for the denial of long-term care insurance benefits.
Yep, great question. So, the claims process is very important as you work through this. There are not what I would describe loopholes in the policies. If you meet the triggers and you're receiving care, you're going to get that benefit. But it's all about the claims process. A doctor does need to sign off that you meet those triggers. You do, if you have a reimbursement plan, you really do need to be paying for that care. And a lot of the top insurance companies have concierge claim processes where they'll actually help you through the process. Your agent that sells you the policy is important in that process too, because they can kind of help you off the record, if you will, make sure that you get your house in order before you ultimately go and make a claim on the policy. There are a lot of regulations around making claims. And so I don't know that there's loopholes, but it's important how you go about making the claim to make sure that policy pays out.
Okay, thank you. What about insurance policies written in one state? Can they be used in a different state?
Absolutely. The policy will follow you. Some states have different regulations, so you may need to pay attention to that, but the benefits will follow you.
Okay, great. A couple of questions about policies that limit which nursing home or facility you can go to. Is it dictated by the policy?
Not necessarily dictated by the policy, but what you might find is that your facility of choice may cost more than what your policy pays for. And so inherently, you may be picking up some of that cost. The bigger conversation is around if you're receiving informal care, right? A family member is taking care of you, a friend is taking care of you. If you don't have an indemnity type policy, you're not going to receive benefits under your policy.
Okay, a question came in about what happens if the insurance carrier becomes insolvent or files for bankruptcy.
Yeah.
What are your options?
Yeah, big question there. And so there are some protections. There are state guarantee funds where kind of the life insurance industry has to pay in to the state guarantee fund. The state guarantee fund will come in and help a failing insurance company work out what to do with the policies. Often that looks like they take kind of the failing insurance company, they take their policyholders and say, okay, John Hancock, as an example, you take part of these policies, and MetLife, you take part of these policies, and all of the other insurance companies that are active in the insurance in that state have to take over some of those policies. Sometimes the policies go into kind of a runoff company where the company just exists to kind of pay out the residual benefits. But it is a risk. Typically, you won't be left with zero. Even if the insurance company gets in trouble, some benefit will pay out, but that benefit may be reduced or limited, or may come from a different insurance company than the one that you originally purchased it with. But definitely important to look at the strength of the insurance company.
Yeah, I think we're almost at time, so I'm just going to ask one more question. Came in about locking in premiums by purchasing a policy sooner. Is that
Yes. Yep. So premiums are largely based on your age, your gender, and your medical history. So the younger that you buy the policy, the lower the premium will be. Having that said, with traditional long-term care, they can increase the premium over time. With the life insurance long-term care policies, sometimes those premiums are locked in, sometimes those premiums are not. But as a general rule, premiums will be lower if you buy it at a younger age rather than an older age. And typically you're healthier when you're younger as well. I'll volunteer. My contact information is in the presentation. I think it's been distributed. Feel free to reach out to me. I'm happy to have kind of an informal conversation and answer any direct questions. I know Washi will do a great job of following up with folks. If you didn't get your question answered, we're happy to do that. And we're happy to be a resource. This presentation is being recorded and will be available on the website. We did a previous conversation about life insurance specifically. So if you have more life insurance related questions, go back and look at that presentation as well.
Great. Thank you, Tyler, for sharing your expertise with us today. If you'd like to connect with Tyler or me with specific questions, our contact information will be sent out. Also, you'll be receiving a follow-up survey about this presentation, and your feedback is extremely helpful, ensuring we're providing our donors and friends with webinars that are informative and timely. If you have suggestions for future webinars, also please let us know. Many thanks to all our guests for joining us this afternoon. We hope you enjoyed the program and look forward to seeing you at our next webinar. Please stay safe and well. My staff and I look forward to an opportunity to gather again, both virtually and in person when it is safe to do so. In the meantime, I hope you look to our team as a resource. If you have questions or would like to discuss a planned gift to Washington University, please don't hesitate to reach out to our plan giving office. Thank you and have a great day.